Hi, everyone. So my name is Amy. I'm a board member of APA UCLA, which is Asian Pacific Alumni of UCLA. So plug, if you're interested to join, let us know. We also host a lot of other events. So I've been doing taxes for 7 years, and I've been licensed as a CPA for 5 years now. I graduated from UCLA with a degree in economics and a minor in African American Studies. And I'm currently getting my master's at the bad school across town. So as I'm going through the presentation, I'm just going to present some, commonly asked questions and common misconceptions about individual and business tax. And feel free to type out any questions in the chat window. Make sure it's being messaged to everyone. And then we'll have a Q&A at the end. And if you have any questions on what's currently being talked about, you can comment that as well. And like if I'm able to, I'll address them as we go along. So, okay, let me share this presentation. Okay, good. Okay, so this is Navigating COVID Part 2, Tips for Businesses and Individuals During Tax Season. So starting off, I just want to talk about the CARES Act. I'm sure all of you know about it. The biggest items are the stimulus round 1 and round 2. So this is actually pretty important when you're preparing your taxes for this year. If you were eligible to receive it last year, you should definitely tell your tax preparer how much you got, because if you are eligible for more and you didn't get it, then you can get it as a credit on your tax return. And also, for those who are in the bracket of 18 and 26, I believe, who are dependents and could not receive it, but this year you're claiming an independent, you can receive it as a credit on your tax return. So definitely make sure you report that on your tax return. The second thing is health insurance. Starting in 2020, California, unfortunately, is giving people a penalty if you didn't have health coverage. And depending on what software you're using, sometimes it automatically penalizes you unless you check the box saying you did have insurance. So definitely make sure you're not accidentally giving yourself a penalty. Another important thing is charitable contributions. So the CARES Act allows everyone, regardless if you're taking the standard contribution, standard deduction or not, to get up to $300 deduction. This can make a difference on your tax return of maybe like a $50 refund. So, it's not a small number. Definitely make sure if you did make a charitable contribution to get that included on your tax return. And maybe relevant for some of you, the required minimum distribution age for taking money out of your retirement increased from 70 and a half to 72. Some of you, this might make a difference. Okay. So for businesses, if you guys own small businesses, I'm sure you're familiar with the PPP loan. The government officially updated this as non-taxable income for loan forgiveness, as well as expenses that you use the loan to cover can still be taken as a deduction. And if you have any questions on getting that forgiven, make sure you ask a CPA or ask someone, or you can ask me later. For those who are filing California sales tax, the first quarter sales tax, so that means sales tax that was due January 31st, got extended to April 30th, as well as the payment date. And if they're going to extend anything after that, keep posted. Just make sure you're aware of that. And from 2018 to 2020, net operating losses. That means if your business had a loss, normally you could not carry it back 5 years, but the CARES Act allows you to take back the losses 5 years. So if you had, a big loss in 2019 or 2020, you can actually go back and amend your let's say your 2017 return and use those losses and get back a refund. So, make sure you're aware of that. If you do have losses that can be utilized in a previously profitable year. And the qualified business building improvement. So the CARES Act actually fixed a mistake that was on the Tax Cuts and Jobs Act of 2018 that had disallowed business building improvement. So if this applies to you, definitely look into it. I won't go too deeply into it. If you have questions about it, you can ask later. So this is the age-old question I get as a CPA. Should I open an LLC or S Corp? So hold on, sorry. So, oops. The biggest answer is it depends. It depends on a lot of factors. I listed out a couple of common ones. So does your business have high gross income or high net income? High gross income is let's say you're like a retailer. So you sell a lot of stuff, but you also buy a lot of stuff, right? So you have high volume, high transactions, but at the end of the day, your net income is low. Versus high net income where maybe you don't buy a lot, maybe you don't sell a lot, but you're very profitable. So it depends. LLCs are taxed on gross income and S Corp is taxed on net income in the state of California. Are you gonna have more than 100 partners? S Corps are capped at 100, LLCs is unlimited, I think. Are you gonna have foreign partners? Again, LLCs, you can. S Corp, there's some rules based on, are they resident aliens, non-resident aliens? So you definitely want to look into that. LLCs are more flexible with distributions and allocations. So if you're someone, this is bad tax advice, but if you're someone who's not very detailed at keeping track of your business and you're just taking money in and out of your account, don't do an S Corp, do an LLC. S Corp, you definitely need to have cleaner books, more structured transactions. And the way LLCs and S Corps ultimately pay tax is different. LLCs, you have to be on top of it, or your tax preparer, you have to prepare quarterly estimates to pay your taxes throughout the year. So January, April, June, September. Whereas an S Corp, you're paying yourself a salary, and through the salary you have payroll withholding that pays taxes. And then the last item is unreimbursed owner expense, which I will get into a little detail shortly. This only applies to LLC. What it is exactly what it sounds like. So, let's say as a partner, you put in a lot of personal expenses that you end up not paying yourself back. You don't reimburse yourself through your business. An LLC partner is able to deduct these unreimbursed expenses, whereas an S Corp, you're not allowed to. So definitely things to keep in mind. So this is a comparison, a quick comparison I put together of LLC versus S Corp versus C Corp. So when people ask me what structure I should use, or should I be a C Corp, I generally tell people, if you don't have a particular reason already of why you want to be a C Corp, then the answer is probably no. If you want to do C Corp, you should already come to me with reasons. I want to do it because of this, this, and this. Okay, that's fine. But if you don't, then probably not, because there's a lot more rules to follow that are time consuming or maybe expensive. So I'll just briefly go through this. Like I said, LLC is more flexible in terms of structure, in terms of allocations, putting money in, taking money out. LLCs are taxed on self-employment income and ordinary tax, whereas S Corps are taxed at payroll tax and ordinary income tax. C Corps have their own tax structure. They have a corporate tax, and when you either pay yourself through a salary or pay yourself a dividend, that thing gets double taxed. So there's a lot more planning involved. And LLCs and S Corps are what you would consider flow-through entities. That means the entity itself does not get taxed. It gets taxed on your personal tax return, whereas the C Corp, the entity itself pays tax. As I mentioned earlier, the LLCs is taxed on a gross income tax. So that means, let's say, your company sells $1 million of an item. You're going to get taxed on that $1 million, regardless if you made a profit or you had a loss at the end of the year. The S Corp, let's say your net income ends up being $20,000 on that $1 million. So you're going to get taxed on the $20,000. So, if, again, that's a little bit of planning. If you know that that's something you definitely want to keep in mind. If you're going to have a high net income, maybe an LLC is more favorable for you. But again, you want to keep in mind, you're not going to only pick the structure based on this item, right? But it's definitely something you want to keep in mind, because you want to make sure you have enough money set aside to pay that gross income tax. Even if you lose money, you're still going to have to be on the hook for the California gross LLC tax. An LLC, I think, is the easiest and most lenient in terms of bookkeeping. The S Corp is a little more structured, so you're going to want to have, cleaner books. You might need to hire someone to do bookkeeping. C Corp, there's more reporting, there's more record keeping. I definitely recommend, if you're going to choose a C Corp, you definitely need to know why you're doing it and be more versed on those things. See. And like I said, LLC can have unlimited owners, S Corp max 100. And so another interesting difference is that LLCs and S Corps, their existence is tied to the owners. So if the owner passes away, the entity kind of just disappears. Whereas a C Corp has perpetual existence, which means it exists outside the owners. So whether the owners pass away or give away their shares, the C Corp is always going to be there as an entity. So if that's something you're looking for, especially in the startup field where you want to go out and get investors, or that it's something where you need to raise capital, or you want to get a lot of people involved, then maybe C Corp is something you want to look into. Again, I definitely advise that you do your research on which structure you want to pick. Is there any questions so far? I can't see the chat window. Let's see.
Yes, we have 2 questions.
Okay.
So the first question,
I can't see the chat window. Why is that? Okay.
Is during the pandemic, through the last whole year of 2020, I found myself working at home and doing Zoom more than ever. My question is related to the claim or deduction for the portion of the living space that I used for my business. And if you could please point out what I need to document.
Haha, that's my next slide. I will get to that shortly.
And then another question that was also asked was, what is the difference between gross income and revenue?
Okay, so gross income versus gross revenue is technically, for most intents and purposes, it's the same thing. It means the total money you've taken in. So you sell a bunch of different things, just the total money you've received before accounting for any expenses. That's your gross income / revenue. Your net would be after subtracting all your expenses, your costs of goods sold, your shipping, your office expenses, rent, et cetera, everything. At the very end, when you get to the end, that's your net income. So income minus all your expenses is your net income. Okay, and then can you comment on Delaware Corps? I'm not sure if I have a specific slide on this, but so also when people ask me if I should open an out-of-state LLC/corporation, the first thing I tell them is, if you don't have a specific reason, again, then I wouldn't, because, well, because it requires a lot of planning and you might not know what you're getting into. So definite no's is if you're a California-based service business, right? Like, let's say you're a common one would be like consulting, or you're a real estate agent. Definitely no, because the way California taxes is if you earn income where you are physically. So no matter if you're providing service to someone out of state, you are physically here. So that means the income that you earn is going to be assigned to California. So California is going to tax 100% of that income anyway. So if you're a California-based service business, then the short/medium answer is no California entity. Stay a California entity. If you sell online digital goods, that's something we can like visit in private, or you should probably talk to somebody, because the digital space is kind of a gray area. So, you know, you may be able to owe less tax if you are an out-of-state entity. And something that could be a yes is if you sell retail items, right? Like physical goods. If you have an online store that ships items to out-of-state customers, let's just say merchandise. You have an online store that sells merchandise to out-of-state customers. Let's say you're a Delaware entity. The short answer is the items that are shipped to other states get assigned to Delaware, and the items that are sold to California customers stay in California. So that portion that is not California sales are Delaware and therefore escape California tax. So that may be beneficial. But then the other thing you have to consider is, because you are still here, you have to register a California entity. So now you have a Delaware entity and a California entity. So you have to pay file in 2 states and pay 2 states of filing fees. So you want to make sure that you're doing high enough volume out of state that it makes sense to pay someone to file extra, to pay someone to do the record keeping, and pay 2 states of fees. I hope that answers your question. State and local tax is pretty complicated. And if it's something that does make a difference in your business, you should definitely talk to like your designated tax preparer. Okay, so back to the slide. Shoot. So can I take home office? This question comes up a lot. Very, very, very unfortunately, the most recent Tax Cuts and Jobs Act disallowed home office expense for employees being W-2 earners. The Tax Cuts and Jobs Act actually removed the line item called unreimbursed employee expenses. So previously you were able to deduct like your telephone, your car, like office uniforms, home office, if you were an employee, but that took it away. And it's supposed to come back in 2026 unless something changes. So we'll see. But if you're an employee, the answer is a definite no. If you are a sole proprietor, an LLC, or a partnership, you can. And the way you do that is, the rule is you need a dedicated office space. So the example is, if you do office work, or if you do business work at your dining table, but you also obviously eat at your dining table, you cannot take your dining table as a home office expense. You have to have a dedicated space, whether it's a dedicated desk, a dedicated room, a dedicated corner of your room. just a space that if you were to look at it, you could say or argue very reasonably that this is obviously an office space, like a bookshelf with all my office books, a desk that I don't use for any other purpose. That's a dedicated office or room. And what can be included in home office if that qualifies. So you take the square footage of that office space divided by the square footage of your whole house, and you get a percentage. And then you can use that percentage to take your rent, your utilities, any repairs, basically anything related to any expenses related to your home. You can take a percentage of that because that percentage is your home office. If you're an S Corp or a C Corp, it's a little more complicated and needs planning throughout the year, because the S Corp doesn't have a home office, right? Because it's a business. So essentially, you as the individual or as a shareholder have a home office, and you're submitting expenses and getting reimbursed by your S Corp, right? So you need to have that record of you requesting reimbursement and your S Corp reimbursing yourself. The actual paper trail of that needs to be recorded and needs to be a little more detailed, and we can go over that later, or you can ask later about it. So how do I keep track of expenses? So this is for businesses, S Corps, LLCs, sole proprietor, C Corp. The best thing you can do is have a separate checking and business account, separate checking and credit card. The next thing you can do is use your personal checking, but have a business credit card that you used for expenses. And if you can't get a separate checking or credit for whatever reason, you can use your personal accounts as long as you are tracking it in Excel as you go. The worst thing you can do is go through the entire year, have no records, have a ton of transactions, especially cash transactions, not keep your receipts. And then at the end of the year, you're like, okay, I need to file my taxes. I have no record of anything I kept all year. Don't do that. You're gonna get really frustrated. Your accountant will get very frustrated. And it's bad because, if you do get audited, it's really hard to find those records because you don't have records of anything. And a comment on QuickBooks. QuickBooks is great. It's very powerful. It has a lot of features. You can connect bank accounts, credit cards. You can create invoices. You can pay expenses, pay your bills. But it's also very confusing for newbies. Maybe if there's enough interest, maybe we can do like a QuickBooks series one of these days. But I think a downfall of QuickBooks for new business owners is that they make it seem like it's very easy to do it yourself accounting when it's actually not. So, I always tell people that, for some things like QuickBooks and taxes and accounting, it might be worth it to pay someone, whether it be a couple $100s a month or like a couple $1,000s a year, to take care of that for you. So you as the business owner can focus on what you're good at, which is running your business. And, even if you pay someone a couple $1,000s to do your QuickBooks, it might, it might save you more than that in terms of time saved that you can spend on your business. And, maybe you're missing out on some deductions or classifying things the wrong way. And that might end up costing you money on your tax return at the end of the year. So, that's definitely something you want to think about. It's kind of like you wouldn't, when you go to court, you want to hire a lawyer. You wouldn't just go by yourself because you found like a DIY guide online. QuickBooks is kind of like the same thing. So Venmo, PayPal, Zelle, Cash App, these things are great, but also it can be very difficult to keep track of if you aren't typing in comments on the transactions as you go, keeping track in Excel as you go, because at the end of the year, you're just gonna have thousands of Zelle, Venmo transactions and you have no idea what you did. So make sure if you do use these regularly in your business, you are keeping track of it as you go. And Excel spreadsheets are your best friend. Okay. Oh. So I created this this 2-page thing, chart of your deadline. I'll just kind of, well, I'll leave it here while I look at some comments. Let me see. Can you guys see this? Okay. Let's see. Okay, I'll look at these later. So these are your deadlines. Make sure make sure you're keeping track of the relevant ones, whether you're keeping track of it yourself or hiring someone. I don't know, Corey, am I able to share this list with all attendees after?
Yeah, we can send out the PowerPoint.
Okay. Yeah, because I think this deadline is really useful. I put it together and a lot of people said it was pretty useful for them. You know, it covers individuals and businesses, and if you do payroll or pay sales tax. So, you know, there's pretty much a deadline every month, depending on what you have in the second half of the year. You know, something to point out, the April and March extension deadline, even if you extend your tax returns, you still have to pay your taxes. So if you owe a lot of money on your personal tax return, even if you file it in October, you still have to pay it by April. Otherwise, you're going to have a late filing penalty. So if anyone has any questions about the deadlines or what they mean, please comment and we can go over it later. So the most question I get when I do individual taxes is, I owe too much. Is there anything I can do to decrease my tax liability last year? And this is asked in April of this year. And post year end, like after the year has ended, there's not too much you can do other than a retirement contribution, whether it's to a self-employed IRA or a traditional IRA. That's pretty much all you can do. Before the year end, however, you can, you know, like, you know, it's December 31st. What can you do? You can donate to a bunch of charities. You can sell your stocks, sell your losses. You know, if you need to buy any equipment, you can buy it before the year ends, or, you know, prepay expenses if you're on a cash basis, like prepay your insurance or prepay your rent or something, if you really need to take those expenses in the previous year. So I kind of put this because a lot of people ask questions for businesses and individuals. The answer is always, it depends on your situation. You know, what is deductible? What can I deduct? Well, it depends. How much should I pay myself? You know, this takes a lot of planning. Like, it depends on how much your business made versus if you have any other income, then you should pay yourself accordingly to, you know, minimize the taxes on both levels, right? Should I form an out-of-state LLC? I kind of covered that earlier a little bit. If you have a service business, probably not. If you have a retail business, then, you know, you need to plan or analyze, is the extra fees and extra work associated with forming out-of-state LLC, is that beneficial compared to the amount of tax you're going to save? Do I need a seller's permit sales tax license? What kind of goods are you selling? Are you buying raw materials and creating something and selling it? Are you buying wholesale and selling it? You know, you definitely need to look into that. Can I write off my car? If you are leasing it, then yes, some of that monthly lease payment is deductible. If you purchased it outright, whether or not you paid cash or financed it, the monthly payment is not deductible, right? because when you purchase a car, you are depreciating the car as an asset. So your monthly finance payment is not deductible. This is a huge misconception or huge thing I guess people don't realize. They're like, oh, I pay like $1,000 a month for my financing. Well, you bought your car, so you know we're already taking the benefit of that. You can't deduct your monthly payment. Okay, so right now is the Q&A section. And if you have further questions, you can email me personally. I'll be happy to help out. You know, just keep in mind that, you know, this is kind of a public forum, so it's kind of hard for me to give very specific tax advice. I can answer questions generally, but if you want something very specific to your situation, I'll be happy to help you in private. Okay. Before I start answering questions, you know, please check us out. We have a lot of events. Sometime in March and April, Charlene, our lawyer expert, she's going to go over legal tips during COVID, helping navigate. And, you know, we also have a bunch of events throughout the year and normally in person during regular times. So, you know, check us out. We're awesome. Always love to connect with the UCLA community, current students and alumni. Okay. All right, so I'll just go in order. Let's see. Can everyone see these? Our wholesale business received the first business tax. Do you know if I have to pay for this tax? So for the I guess the city of LA will send a form if you own business equipment. Even if you're below the threshold, you should still file the form because they're just going to assume you have, they don't know how much you have. So if you have less than their threshold and you're going to owe zero, you should just file the form anyway. So they don't assume you might have more and then try to hit you with penalties or try to collect on it. Just, you know, file a zero and say, I don't owe anything. The rollback of the losses for the past 5 years, is that only for 2020? So the rollback applies for losses incurred from 2018 to 2020. Does that answer your question, Lawrence Wong? Comment if it doesn't. So, okay, so remote working in 2020, if you, the short answer is if you lived in California for more than half of the year, so 50% or more, then you're still a California resident. And I wouldn't bother with filing non-resident in the other states. But if you were in another state for more than 50% of the year, there may be some tax benefit to filing a non-resident in California and a resident in the other state. So that's definitely something you want to look into. Let me know if you have more questions on that. Software startup. Yeah, software startup is like, that's kind of a specific question. We can look into it. There's a lot more that goes into it. Sorry, Charlie Wang. Yeah, and yeah, it's too specific. I wouldn't be able to answer that without more details. Ramona, hi. Mentioned something about real estate agents. Could you ask that again? I'm not sure what you're talking about. Ramona Wu. So,
hi.
okay, so, okay.
Yeah, I just heard real estate, and then that's when I like kind of try to listen, but then you moved on to talk about something else. I was just wondering what you mentioned about real estate, because then just to see what you.
Oh, I think I mentioned real estate in terms of like forming out of state LLC.
Okay.
Yeah, if you so that's interesting. If you, let's say you own like a Nevada, if you're a real estate agent and you provide services, you should just probably form like a business in the state you live in because you're here and you're providing services from here. I can probably do like a real estate session another time, but like if you, let's say the out of state thing, if you own a property in Nevada, then there is no problem with creating a Nevada LLC for that property, because that property is physically in Nevada and it's providing service to people who are in Nevada. So that's no problem.
Okay, thanks.
Yeah. Let's see. Sunny Samra asked, if I intend to have my S Corp pay my personal account for office space, does the office rent paid need to be physical checks or transfers? Doesn't matter, as long as there's a transaction that's happening, physical, paper, Venmo, it really doesn't matter. Even if you are recording it in Excel, you're being reimbursed this much money every month. Some kind of record. Let's see. Can you go over remote working? Okay, I want that. Is there a penalty? Yes. So Sally Lou asked, is there a penalty for filing 1099 NEC forms late? Yes, unfortunately. So the IRS website actually has the penalty. I believe like if it's 1 month late, it's like $40 or $50 per form. If it's more than a month late, the fee increases. Let's see, late penalty for 99 NEC. If you just Google it, the IRS. So this year it's $50 per NEC filed late within 30 days. $110 per form if you file more than 30 days, but before August 1st. I hope that answers your question. So Alina Doe asks, I received a retainer for future work, but I'm on a cash basis. How do I file for 2021? So Alina, if you can clarify if I'm wrong. So that means it's 2021 and you receive like $10,000 payment, but it's for future work that you're not going to do until 2022.
Right. So I'll do some work in 2021, but some work probably in the future after 2021.
If you want to get into specific, we can talk privately, but maybe in that case, you might want to consider being on accrual basis, because that's technically what's your situation is.
Can I switch? Like, because I've already filed taxes on cash last year.
It's no problem to switch. Generally, there's no issue to switch.
Okay.
Or you can take the hit this year, and then next year you can have a bigger amount of expenses. So, again, it depends. The general answer. But if you want to talk offline, we can.
Great, thanks.
Yeah. Andy says, sorry, no dumb questions. Do I need to file taxes I made for selling on Facebook Marketplace? I mean, unless you're selling like thousands of dollars and making a business out of it, if you're like, if you sell a couple items, even a couple thousand items, a couple $1,000s worth of items here and there, probably not. But if it is somewhere where you cross a threshold of like, this is a significant amount of money, let me know, we can talk about it. Okay, so Ben Zhang asked, if you have multiple income streams in retail and another in service, is it better to file with multiple EIN or have them combined in accounting? Again, I always preface it with, it depends. So the short answer is yes, there is no issue with having it in the same EIN. Like if you want to just have everything under one umbrella business, and then report it on the same page, it's fine, and then on your own record keeping, have separate columns for your different activities. That's fine. And then on the other aspect, you want to consider like, the legal thing. If someone sues one branch of my business, is it going to affect the other branch liability wise? But in terms of accounting and reporting, there is absolutely no problem with that. Okay. So Alan, hi Alan, says, I have a service-based California LLC. One of my old clients is requesting a W-9, but none of my other clients that I serve monthly has ever requested a W-9. So, so if someone is asking you for a W-9, that means they paid you for services that you provide, right, Alan? Like, so that you received money from them. Am I understanding right? Okay.
Yes, I did, Amy. Sorry. Try to unmute.
Yeah. Yeah. So the reason someone asks you for a W-9 is to collect your information, so they can issue you a 1099 miscellaneous / NEC, right?
Gotcha. Yes.
So that's why someone will request a W-9 from you, and vice versa. If you paid someone and you want to issue them a 1099, the formal way to ask is through a W-9. The informal way is, yo, give me your name.
Okay, perfect. Now, do I have to continue doing that with any of my current clients at all? If they don't have, if they don't request, if none of my current clients request a W-9 from me, I can just continue business as usual.
Yeah. So issuing someone a 1099 is on them, right? So
Gotcha.
if you pay them and they don't give you a 1099, wait, the other way.
Yes, they pay me, but they don't request for a W. Yeah.
If they pay you and they don't issue you a 1099, that's on them. Like they're the ones that get in trouble.
Gotcha.
So
Okay.
don't worry about it.
Sounds good. Thank you for clearing that up for me.
Yeah. Okay. So Katie says, for S corps, what do you mean when it comes to documentation for a home office? Is it as simple as a reimbursement with home office expenses plus receipts? Yes, it is as simple as a reimbursement. So there's like a formal way to do it called an accountable plan. If you Google accountable plan, it's like you'll see it's kind of like a official way to submit expenses and get reimbursed. But if you can kind of imagine, like, you work for a company and you pay for something and then you submit a reimbursement request to HR and then they pay you back. That's kind of the same concept if you have an S corp. So, what I would do is, like, every month, keep track of what you're spending, and then that when the S corp pays you, on the S corp site made a note, reimbursement for so and so expense, reimbursement for monthly rent or something. We can talk offline about this, but the formal way is an accountable plan. The informal way is, like you said, keeping the reimbursement form with expenses listed. So you're welcome, Sunny. Can you briefly elaborate on tax deductions for a business vehicle? You said only lease payments are eligible and not monthly payments for a purchase. Is it as black and white as you say? I was informed that it doesn't matter if it's a lease versus purchase. Sunny, are you familiar with depreciation?
Yeah, I do know what you're talking about with depreciation. And so I guess there's only, like, you wouldn't be able to deduct the whole amount when you purchase rather than lease, but that you would still be able to deduct a certain portion of your payment. But I wasn't sure though.
So let's say let's just like use an easy example. Let's say your car that you buy is 100% business related. And then, so let's say the car is 100% business, right? And your monthly lease is like $500 a month. So if it's 100% business, then you're able to deduct $500 a month for your car, because that's your monthly lease payment. If you purchase the car, then instead of deducting whatever monthly finance charge, let's say the car cost $20,000, you would add the car as a business asset and then depreciate that car over the useful life. Or if it's a qualifying truck over 6,000 pounds, you can like bonus depreciate it the whole, all in the first year. And if it's like, 70% business, then there's a lease inclusion formula for leases, roughly around 70% of your lease is deductible, roughly around 70% of the car is depreciable.
So if it's for your example, say it's a $20,000 car and 100% being used for business, how would that really work in terms of depreciating over time?
I think the car is 5 years depreciation. I have to double check actually if I can take all of it in the first year, but generally speaking, so you take you divide it by 5 and take the amount over 5 years.
And that would be what you would still have to file like a yearly, you file taxes yearly, so then you would divide the 5 by.
Yeah, the software should do it for you. Like you take 4,000, it counts as 4,000 per year against your business income.
Okay.
Yeah. It's the same as if you like bought like a piece of equipment or something, you depreciate it over 5 years, over 7 years. Same concept. I hope
So
that.
yeah, that kind of does answer my question. So I guess it doesn't matter then. Like you don't necessarily need to lease a business vehicle. You can still buy it. It's just a different kind of structure and how the deduction works.
Yes. Yes.
And it sounds like the lease is easier to deal with just because it's more kind of straightforward, but you can get the same result either way.
Yeah, pretty much. I tell people like, how people are like, oh, if you own a business and you lease a vehicle, you get the deduction. It's kind of like the way I see it is you get a 30% discount on the lease, right? Like let's say it's $500 a month and you write off 100% of it. In tax, you have a 30% tax rate. So, you saved 30% on your lease payment, if that makes sense.
Yeah, that makes sense. So like you shouldn't just lease a car just to write it off because then you're paying more, but.
Yeah, I mean, it all depends on your philosophy, right? Like, like me, I don't think I would ever lease a car just because like, I'm like, why would I pay someone something that I'm never going to own? But, then I think it ultimately depends on your personal car philosophy. Either way, you're getting some kind of benefit.
Okay, that makes sense. Thanks.
Mm-hmm. Okay, Cherry Lee asks, question about 1099 NEC. My LLC paid over $600 for attorney fee. My attorney said she doesn't need the form as the firm was structured as an LLP. Oh, okay, I still filed the NEC with the IRS, but I didn't send it to her. Is that okay? If you filed it, you should probably send it to her because now it's going to be on the IRS's record, and she didn't have it. I'm intrigued though, because LLP means that you should be getting an NEC. So I don't know why she would say that, but yes, if you filed it, you should definitely give it to her. So, and I already have an HSA account. Can I also have an FHA? That I am actually not too sure about. I'm not too sure about healthcare stuff, sorry. So Charlie asks, have you ever dealt with social media accounts that monetize syndication, i.e. different contributors?
Sorry, I think syndication might not be the right word, but like there can be like blogs sometimes where people post guest posts or other writers, if that makes sense. And if you want to pay out like ad revenue based on that page's advertising, is that something that's pretty complicated or I don't know if that's something, like TikTok blogs.
So are you making money? So can you give an example?
So like, for example, if you have a YouTube channel and you're making money off of ads, but there are different people making videos, is that something that's, where like maybe a sole proprietor
what do you mean
paid
what do you mean different people making videos?
So like, usually YouTubers are like one person.
Okay.
Or but can you have like a YouTube channel where you have different people contributing and you pay out advertising based on the different videos.
So like you own the channel, but let's say 5 people contributed to the video and you get paid everything, but then you're paying these other people like as a second transaction.
Yeah.
Okay. That's pretty common like in all areas of business, right? Like one person gets money and then they pay like other people. And I have dealt with that in the entertainment area. It's really easy to categorize, or it's really easy to record the transaction. We can talk about it offline because we have a few minutes left, but feel free to email me.
Okay, sounds good. Thank you.
Yeah, so Alina, can you explain QBI a little? So in short terms, in layman's terms, QBI is 20% off the top of your business net income if you qualify. So if you are a qualified business that you're under a certain threshold of income, let's say your net income is 100,000, instead of being taxed on the full 100,000, you get a 20% discount. So you're only taxed on 80,000 of your income.
Can you explain the qualifications more?
So qualified businesses, if you are a service business, then there's like it's like different thresholds. Like I think like if it's like 100, there's like 140,000 AGI limit. Like industries like lawyers, accountants, entertainers, they have like a limit. So I mean, what industry are you in?
Sorry, I was muting. IT consulting.
Okay, so consulting, yeah, there's like a limit. So you'd be a qualified service industry. So this is, I guess this is something that that'll come up more when you're doing your tax return. I mean, you can't really change what industry you're in to plan for it. It's just like you have it or you don't have it. So I hope that answers your question. If not, email me.
Okay, thanks.
Okay.
The inquiry.
So if I have foreign income and pay taxes in the foreign country, do I have to report and pay again in the US? It depends on how much foreign income. If it's significant, then that foreign country should probably have issued like given you a tax form of withholding. And then when you report it on their US, you get a credit for it. If it's like a few dollars, then I think it's pretty like, then I guess it really doesn't matter. So I guess it depends on the threshold, like what dollar amount we're talking about. But yeah, I mean, if you have like a question on something specific, you can email me. I think, did I get everyone? I hope I did. I hope I was able to answer your questions. If not, you can email me or email somebody. So I mean, so we're almost out of time. I really hope this was helpful and answered a lot of common questions. You know, if we get good feedback on this, I definitely would like to do, you know, another series on QuickBooks. I want to do something on real estate, like, you know, if you own rental property and file a Schedule E, I think a lot of people, in my experience and people I know, they have a lot of questions and misconceptions on that as well. Okay, yeah. So yeah, I mean, if you have any feedback, feel free to email me. If you have any questions, you can email me. If you want to hire me, I am a CPA and I do have my own business email. So you can email me on that too. Shameless plug. But yeah, you know, please continue to support APA UCLA. We have a lot of awesome events planned for you guys throughout the year and in the future.